there! If you are currently working or planning or even considering a career in financial accounting, and whether you have currently zero or some background in accounting, this video will teach you from scratch or solidify your understanding of the bedrocks of accounting. That is, the fundamental accounting concepts, principles, and their practical applications. Hi, this is Solomon Tafari. I'm an accountant and a business and accounting instructor here in US. Now, before starting, I have a couple of tips for you. The first tip is that while watching this video, you should not let familiarity undermine the level of your attention. Now, what do I mean by that? Well, this video is delivered in a straightforward language, reinforced by visual aids to ensure that even someone with no accounting background whatsoever can effortlessly understand everything. Now, with that being said though, terms or phrases seemingly having obvious meanings in common sense may or may not have the same meaning in accounting. So, regardless of your familiarity with a word or a term, pay close attention to each definition, illustration, and so on in this video. Alright, the next one is about a word frequently used in this video: entity. The word entity can have meanings with slightly different nuances depending on the context it's used in. While all other technical terms used in this video are defined and explained in the main content later, we're defining the word entity now than later, as it is used too many times in this video. So, the word entity, as used in this video, has a simple meaning of any organization legally formed to conduct any type of business. That's it. Finally, if for any reason you don't quite understand any topic or a piece of idea, or you have any other comment, drop your questions or comments in the comment box below, and they will be addressed as quickly as possible. Alright, enough with the talk, let's dive in. We have 4 sections in this video. The first section is very short, and it is where we simply define accounting using an illustrative diagram. Then we will sequentially advance to the next sections and explore these building blocks of accounting: double entry, accrual, and the accounting period. In some of these sections, we're unlocking other core accounting terms and concepts such as debit and credit, transactions, accounts, and so on. If for some reason you want to directly jump to a specific topic in this video, you can do that using the links provided in the description box below. Let's now move to the first section where we see an initial definition and illustration of accounting. Here is a concise and functional definition of accounting. Accounting is a system or process whereby financial information of a business entity is collected, recorded, reported, and analyzed. Just to give you a more clear-cut understanding of accounting and the activities of collecting, recording, and reporting, let's see a diagram to visually illustrate accounting. This diagram is a visual representation of the different phases and activities of accounting. At the beginning here, we see data flowing in. Let's name that point A. And here in the middle, at the core, we observe some kind of processing. Let's name that B for now. And the delivery of outputs at the end occurs at this point, and let's call that C. Each of these letters, A, B, and C, now represents the core activities in accounting. At point A, the collection of financial information occurs. Point B represents the recording activity, and point C represents the reporting activity. Now, to shine some light on those activities, where do we initially collect raw financial information from? Financial information is collected from different sources. The most common and widely used sources are what you see up here: contracts, invoices, bank statements, and receipts. These documents are referred to in accounting as source documents or supporting documents. Once the information collected is processed in the accounting system, that means once the recording activity is complete for an accounting period, like a month or a year, different types of outputs are produced. We will discuss accounting periods in the last section of this video. The primary outputs are the ones shown here: balance sheet, income statement, and cash flow statement. These outputs are called reports, or more commonly they are called financial statements. So this is a general but concise representation of accounting that can help you visualize accounting at a glance. Now we're moving to the detailed sections. We just defined accounting. In this section, we're closely looking at one of the most important building blocks of accounting: double entry. But before directly discussing double entry, let's first identify and define the foundational concepts. Here we have very important and fundamental accounting terms you need to know to properly understand double entry accounting. These terms are financial accounts, transactions, and debits and credits. Now, let's spend the next few minutes looking at each of these three terms, starting with financial accounts. Financial accounts, or simply accounts, are classifications of financial resources of an entity. Now, to clarify, think about all the properties or financial resources such as cash in bank or cash on hand, or non-cash items like buildings, equipment, and so on that are owned or held by a company or an individual. The owner or owners of these properties and resources are not the only parties who have a stake in those properties and resources. Other parties also having a stake include creditors and lenders. So that means everything a company owns typically originates from different parties and so is claimed by different parties. That is, one or more owners and one or more lenders or creditors. So that is one of the reasons classifications of financial resources is needed to accurately represent how much belongs to whom. Another reason requiring classifications of financial resources is the identity of the resources themselves. For example, $5 million cash and a building worth $5 million seem to have equal values in monetary terms, right? But they have different identities. One is cash and the other is building. That is why accounting is not only quantitative, but also qualitative in nature. In other words, in addition to presenting monetary values, classifications of financial resources also helps us to know what is behind those values. For example, how much of it is cash, how much of it is other properties, how much of it is debt, and so on. Yet another reason for classifications of accounts is that all incomes generated and all expenses incurred by a company have different sources, uses, or purposes. Classifications of financial accounts also helps us keep income items separate from expense items, as well as further separating income and expense items within their own category based on the type of their sources and their purposes. For example, an expense incurred to purchase office supplies and an expense incurred for repair and maintenance of an office building are in the same category because they are both expenses. But their purposes are different and should be separated accordingly. In accounting, this classification of financial resources is what creates financial accounts, or simply accounts. For example, cash, buildings, equipment are all financial accounts. In the same way, all kinds of debts, for example, mortgage loans, unpaid bills for services or goods purchased, and so on, are all financial accounts. Also in accounting, those financial accounts similar in nature are grouped together and reported both individually and as a group. Now, let's specify and have a close look at each of these classifications or groups of accounts and how similar items are grouped together. There are 5 classifications or groups of financial accounts: asset, liability, equity, revenue, and expense. In a second, we will define and explore each one of them. But for now, simply note that the accounts you see on the left here, asset, liability, and equity, represent what is owned versus what is owed by an entity at a specific point in time. In other words, they answer the question, how much is an entity worth? Which is everything owned by the entity, that is the entity's asset, minus its debts or liability at a specific point in time, such as now or at the end of last year, and so on. For example, if you say you're worth $500,000 today, you mean that today your equity is $500,000, which is the value of all your assets, such as your cash, savings, the value of your house, your car, and so on, minus all your liabilities as of today. Whereas the accounts you see on the right here, revenue and expense, represent what is earned versus what is incurred during a certain period. In other words, these ones answer the question, how much does an entity make as income and how much does it pay for expenses over a certain period, such as a month, a year, and so on. For example, here if you say that your revenue last year was $100,000 and your expenses that year added up to, say, $65,000, you mean that your total income earned before making any expenses was $100,000 and you incurred a total expense of $65,000 last year. All this will be very clear in a moment when we go over each one of them. Let's start with the first classification of accounts: asset. Alright, here is what an asset means in accounting. An asset of a business entity is any resource with a future economic value owned or controlled by the entity. This definition is a common definition of asset, and the wording here may sound a little convoluted or vague, especially for those new to accounting, but the concept is very simple. It just means that an asset is any property, cash or non-cash, which has a value economically useful for the entity that controlled it. Let's see some common examples of assets. First, we have cash, which is very straightforward. Basically, all cash in bank and cash on hand of a business entity are simply referred to as cash. The next type of asset is accounts receivable. As its name implies, from a seller's point of view, accounts receivable is just money expected to be received from customers for goods and services they purchased on credit. Let's see an illustration to see how accounts receivable is created and what it represents. First, look at the bottom where a timeline marked with 2 points, earlier and later, is shown. Let's see what happened earlier. Some items were sold to a customer on credit. Whenever a sale is made on credit, the selling business entity records accounts receivable for the price of the items sold. And this accounts receivable stays on the books until it is paid by the customer. Let's now move to the future and see what happens when the customer pays. Alright, here at some point, payment is received from the customer for the credit sale made earlier. Whenever payment is received from a customer for a credit sale, the accounts receivable credit is settled or offset by the amount of payment received. The next asset type is inventory. Inventory, in accounting, is anything held by a business entity for sale to customers or distributors. The sale of inventory items to customers can simply be a buy and sell without changing the form or shape of the items. For example, retail stores like Best Buy, Walmart, and the Home Depot primarily buy items from suppliers and resell them to their customers without any further processing. On the other hand, the sale of inventory items can also be buy and use them as inputs to produce other products, where the finished products are the ones to be sold to customers. For example, Apple, Boeing, and General Motors are companies that buy raw materials and produce final products for sale to customers. So, inventory is a common asset type for retail companies like Walmart and manufacturing companies like Apple. Inventories can be anything held for sale. They can be inventory of electronic devices, jewelry, shoes, cars, anything. The next types of assets are very simple and straightforward. They are equipment, furniture, and buildings used by a business entity. Also, keep in mind that some types of items like equipment can be categorized as inventory in one company and as different types of assets in another company. The reason for that is the purpose of the asset held. If an asset item is held for sale, then it is categorized as inventory, and if not, it will be categorized as another type of asset. For instance, a computer held for sale at a Microsoft shopping place is categorized as inventory because it is held until sold. Whereas a computer held at a commercial real estate company used by the company itself, for example, for running and maintaining data, is categorized as equipment because it is owned to keep and use, not to be sold. Alright, we just covered asset. Let's now see the other classification of financial accounts. Liability. A liability of a business entity is any debt or obligation owed by the entity. In other words, any obligation because of past transactions or activities requiring an entity to pay financially at some point in the future is a liability to that entity. You probably observed this in your everyday life. For instance, if you buy a car on credit where you enter into an agreement with a lender so that you pay a certain amount every month or whatever, you now have a liability due to a transaction which is the purchase of a car requiring you to pay money to your lender in the future. There are different types of liabilities based on their nature. Common liability examples are accounts payable, accrued liabilities, notes payable, mortgage payable. A couple of these are straightforward and easy to understand. The others, especially accounts payable and accrued liabilities, may not be readily clear if you are relatively new to accounting. So, let's briefly look at what accounts payable and accrued liabilities are. First, accounts payable. Accounts payable is simply a liability an entity owes to a supplier or service provider for goods and services purchased on account. On account means on credit. For example, let's say ABC Company purchased some items on credit from one of its suppliers sometime in the past. When this purchase transaction was complete at that time, ABC Company records accounts payable in its accounting books. Accounts payable are typically paid in 1 or 2 months. So later, ABC Company pays its debt, which is the accounts payable created when purchasing those items. When ABC Company pays the accounts payable later, it clears or reduces its accounts payable balance by the amount of the payment. Again, the purchase transaction in the past created an obligation which is explained by the accounts payable created at the time of the purchase, and then later, when actual payment is made, ABC Company clears or reduces the accounts payable liability created at the time of the credit purchase. That was an overview of how accounts payable is created and later settled. Alright, the other type of liability is accrued liability. Accrued liability shares a lot of characteristics of accounts payable, except that the amount owed is often estimated. Accrued liabilities are debts because of expenses usually estimated but not paid. For example, let's say your utility company, such as your electric power supplier, sends you a bill every month for electric consumption from the 15th of one month to the 15th of the next month. That is what this means. A utility expense for a service period from and to the 15th of every month creates a liability at the end of every month. Here is why. Most companies, especially the big ones, update their accounting records every month. So, if a company pays its utility bill for service from the 15th of a month to the 15th of the next month, then at the end of every calendar month, there is always 15 days of unpaid service, right? To clarify this more, let's look at this diagram for a moment. Look at this timeline. There are 3 time points: January 15th, January 31st, and February 15th. On January 15th, payment was made for the past period, that is, from December 15 to January 15. Now, at the end of January, that is January 31st, there is no any bill to receive and look at, because the utility company does not send bills until the 15th of the next month, that is February 15. But we received service throughout the 15 days, that is from January 15 to January 31st, and we may not know how much the utility company would charge us for those 15 days of service. So, do we just leave it unrecorded? No. Although payment will not be made until later, we must somehow recognize the expense for the 15 days by recording it in our books. Although we recognize that expense though, we're not really paying anything until the next billing date, right? So, where do we keep the money until then? Until then, it will be considered as a liability, accrued liability to be precise. Accrued means recognized but not paid. Then on February 15, when a bill is received from the utility company, we now know exactly how much we owe for utility up to that day. In this example, up to February 15. We then make payment for 1 month, up to February 15, which also includes the period for which we recorded accrued liability. The accrued liability recorded will then be cleared as we make payment. To put it concisely, accrued liability is an unpaid amount, usually estimated, of a service received that is recorded although not paid, usually at the end of a period, such as a month or a year. Also, the accrual section of this video, which we will get to in a minute, will increase your understanding of this. Great! The next type of liability is notes payable, and it is a liability created because of an entity borrowing money from a lender based on an agreement called promissory note, or simply note. The other type of liability is mortgage liability, where an entity borrows money for construction or purchase of real estate properties and agrees to pay in the future a certain sum of money, including interest. We've so far seen basic concepts on assets and liabilities. Now, moving on to the next financial account, equity. To explain equity in the shortest and simplest possible way, equity of an entity is the net value of the entity. To make it clear, equity is what would be left if an entity paid off all its liabilities or debts. That is what is meant by the accounting equation. What is the accounting equation? It is equity is equal to total asset minus total liabilities. That is the sum of the monetary values of everything a company owns or controls is the company's total assets, and out of these total assets, the portion that is owed to external parties like banks, suppliers is the company's liability, and everything else left, that is the residue, after all liability are deducted from total asset, is equity of the company. I use the word residue on purpose here because in accounting and also in any legal environment, in extreme situations like, for example, if an entity goes out of business or ceases to exist for any reason, the liability of the company should be paid first before shareholders start taking their share. That means lenders have priority over owners of the company. This priority concept is especially relevant to corporations and limited liability companies, or LLCs, because these entities are legally separate from their owners or shareholders. But the accounting equation is always valid regardless of the form or type of organization. Let's look at the main components of equity. There are two main components of equity in any business setting: contributions and retained earnings. Contributions are directly provided to an entity by the owners or shareholders of the entity, whereas retained earnings are the other part of equity, but unlike contributions, retained earnings are derived from profits of the operations of the business entity. Let's leave equity with that for now and move to the other financial account: revenue. Revenue is straightforward. It is simply income that is collected by selling goods or services to customers. In other words, revenue is income collected or generated from operations. Common examples are sales revenue or income, rent income, donations, and so on. The type of revenue depends on the type of industry or business an entity operates in. As you can see in the example, some companies have sales revenue, others rent income, and yet others have donations, and so on. Companies also have complete discretion to name their revenue, to name any of the other financial accounts for that matter, as long as they are fairly descriptive. Good. We covered 4 of the financial accounts, including revenue. And now, moving on to the next, also the last, financial account: expense. Here is a definition of expense. Expense is a cost incurred due to the consumption or use of financial resources in the operations of an entity. We'll see some very common examples in a second. In this definition, it is stated that expense is a cost incurred. But not all costs are categorized as expenses in accounting. What does that mean? If an entity, for example, is using a rented building for an office, paying a rental fee every month, from the tenant company's point of view, the rental fee the company pays may or may not be categorized as an expense, depending on the timing of the payment. That is because for a cost to be an expense, it must be associated with the current period. In the rental fee example, if the tenant company is paying the rental fee for the current rental period, the payment is categorized as an expense, of course. However, if the tenant company also pays rental fees for future rental periods in advance, the portion of payment that is paid for future periods in advance is not recorded as an expense. That is because the tenant has not received the service yet. In other words, they are paying for future unused rental periods. So the payment for these future periods will be kept in a separate account, usually called prepaids, until those paid periods are elapsed, and then the amount kept under these prepaids will be categorized as expense after the elapse of those specific future periods. Although that is an example of a rental expense, the logic also applies to all expense types. Here are some more common examples of when a cost incurred is categorized as expense or not. This is just a compare and contrast of expense types as not expense on the left and expense here on the right. First, we have cost of goods for sale. That is not expense because although an entity incurs costs when it purchases goods for resale, the cost of these goods is not recorded as expense until the goods are sold to its customers. Until then, it will be held under an asset account called inventory, which was briefly discussed earlier under the topic of asset. On the other hand, once or when the goods are sold to customers, the cost incurred to purchase those goods will be recorded as an expense. The reason for waiting until the goods are sold is an accounting principle called the matching principle. According to the matching principle, expenses must be recognized at a time or during a period in which they help generate income. The cost of goods purchased for resale generates income when sold later, right? That is why it is kept under inventory until sold, and then the cost is moved from inventory to expense. This expense is commonly known as cost of goods sold. Inventory accounting is applicable only to companies that buy and sell physical products, but the matching principle remains valid for all expense and revenue items, regardless of the nature of business operations. Other examples are insurance premium paid for next year, not expense for the same reason, whereas insurance premium paid for this year, whatever the current year is recorded as expense. Similarly, salary paid in advance for future periods is not a salary expense yet, but salary paid for the current pay period is expense. Cost to purchase equipment is not an expense. Yes, there is a cost incurred when purchasing equipment, but the cost is not immediately recorded as expense upon purchase. So when is it recorded as expense? The cost of purchasing equipment and other long-life properties is recorded as expense through time as they are used, as they age. So to that effect, depreciation of equipment is recorded as expense periodically, such as every month or every year. So depreciation represents expense in terms of the usage of fixed assets like equipment. Alright, we've seen all the 5 building blocks of accounting. That is the 5 financial accounts, and they are asset, liability, equity, revenue, and expense. Fantastic. Also, don't forget, if something is not clear, you can always drop your question in the comment section. These building blocks of accounting are everything accounting deals with. Good. With that being said, let's jump to the next topic in accounting. Transactions. Okay, a transaction is an event causing change in the financial accounts of an entity. That is a carefully worded definition of a transaction, and yes, I know this definition sounds a little compact, but it accurately describes a transaction. Let's dissect it so it can be super clear. When talking about transactions, the most common transactions that immediately come to our mind are transactions that are conducted between two parties, like a buyer and a seller, that is buying or selling goods or services, or between a borrower and a lender, that is lending or borrowing money. Those are the most obvious and common types of transactions that can bring change to 2 or more financial accounts of a company. For example, when a company buys goods, like a car, which is an asset, it now has more vehicles. That means it increased its asset balance since vehicles are assets. On the contrary, if he pays cash, which is another asset, to purchase the car, its cash balance is reduced as it now has less cash because of the cash payment. Those are examples of transactions between two parties. The other types of transactions are the ones happening inside an entity. That means not involving another party. An example of these transactions is depreciating assets. As assets like equipment, furniture, cars, buildings, and so on age, their value decreases at least because of normal wear and tear. This decrease in value of depreciable assets is treated as a transaction because it changes the balance or the value of the asset and so is recorded as expense in the accounting books. Another example of internal transactions is end of period adjusting entries. At the end of any accounting period, there are some internal transactions called adjusting entries that must be processed to accurately update the amounts or balances of some financial accounts. As I mentioned earlier, we will discuss accounting periods in the last section of this video. Great! We saw fundamental concepts on financial accounts and transactions. Let's now see what debit and credit are and what they are not. Debit and credit are the two opposite effects of any transaction. Whether the transactions are conducted with an external party, as when buying or selling goods or services, or internal, like adjusting entries or depreciating assets, each transaction has two opposite effects: debit and credit. Well, then, what are these opposite effects? These effects of any transaction are increase and or decrease in the balances of financial accounts. Then, do debit and credit mean increase and decrease? Yes, but a debit can mean an increase or a decrease in the balance of an account depending on the type of the account. And same thing for credit. Let's see an example, and right after that, we'll see when exactly a debit or a credit means an increase or a decrease. Again, to the car buying example, if you buy a car in cash, you will now have less cash because you paid to purchase the car. The opposite effect of this car buying transaction is that you now have more cars because you bought a car. In this example, both your cash and your car are assets, and the transaction has opposite effect on each one. It increased one and decreased the other. This is just one example. Now, let's see the governing principle of debits and credits. That is, when does a debit mean an increase or a decrease? And similarly, when does a credit mean an increase or a decrease? All right, here are the two principles or rules of debit and credit. Increases in asset and expense accounts and decreases in liability, equity, and revenue accounts are recorded as debits to those accounts. Whereas decreases in asset and expense accounts and increases in liability, equity, and revenue accounts are recorded as credits to those accounts. Shortly, I will show you how you can easily memorize this. To make it easier and to visualize this concept, let's see it on a table. This is a table showing when exactly a debit means an increase or a decrease, and same thing for credit. The best way to memorize this, you probably noticed, is that asset and expense accounts have the same behavior. They both are debited when increased and credited when decreased. On the other hand, liability, equity, and revenue accounts have the same behavior and they are all credited when increased and debited when decreased. Let's now see some important points related to debits and credits. The first book of record in accounting where transactions are first recorded is the general journal. Whether an entity purchased a car, sold goods or services, or does any other transaction, the effects of the transaction are first recorded in this accounting record, the journal. This original book of records, which is the journal, has a tabular format with a few columns, as you can see. It typically has 5 main columns. 2 of the columns are amount or money columns. The left is always where the debit part of a transaction is entered as a dollar amount, or in other currencies in a different jurisdiction if outside US. And the right side is always where the credit part goes. The first column is for the date the transaction happened. This wide column is for the names of the accounts affected. By affected, I mean increased or decreased. To understand this PR column, PR stands for post reference, we must first understand another type of accounting record called the ledger account. A ledger account is a separate record for each financial account. For example, cash has its own ledger. Similarly, vehicles, equipment, and so on have their own ledgers, where increases and decreases are recorded, and final balances are maintained. Let me clear a few points here before going back to the journal. Each of the accounts you see here shows only a simplified version of a ledger account. The full version of a typical ledger account looks something like this. As you can see, it has the name of the account at the top, a date, particulars, and debit and credit columns. In general, a ledger account shows the effects of transactions, that is, increase or decrease, on the account specified at the top, along with an ending balance at any point in time. Here, I grouped the accounts based on their classification of accounts. That means the ones you see here are asset accounts, the next ones are liability accounts, these are equity accounts, and the last two are revenue and expense accounts. All ledger accounts that a business entity maintains are collectively called general ledger. Here, if you noticed, increases in asset and expense accounts are recorded on the left sides, which is the debit sides of the ledgers, and decreases in these accounts are recorded on the credit sides of the ledgers. In contrast, liability, equity, and revenue account ledgers follow the inverse rule, which is consistent with the rules of debit and credit we saw earlier. Now back to the PR column of the journal. The PR column in the journal is a reference column that ties a journal entry to a ledger account, as each transaction in the journal is later transferred to its respective ledger account. These last two columns are our points of focus since our current topic is debit and credit. Let me enter the car buying example transaction here. The date the car was purchased is entered here in the date column. You're extracting the information from your source documents. In the car purchase example, the purchase agreement and/or the payment evidence are your source documents. Usually, the first account you enter is the debit part. No reason for that at all. It's just a matter of convention or norm. But it's a good practice anyway, as it at least gives journal entries a consistent look. So we enter the name of the account being debited here. In our car purchasing transaction as a purchaser, we acquired a new car because of the transaction, right? So our pool of cars increased. Since our vehicle property increased and a vehicle is an asset, what do we do when an asset increases? Yes, debit. So we enter the name of the account here, that is vehicle, and on the debit side, right on the vehicle line, we enter the acquisition cost, that is the purchase price. Other costs like shipping cost, commission, if applicable, are added to the cost of the vehicle when recording. But we're not worried about that for now. So we enter the purchase price on the debit side right on the vehicle line. In the car purchasing example, cash was paid. Since cash is also an asset and our cash resource or balance is now decreased, we credit cash. All we do is enter the name of the account here, that is cash, on the second line, and the purchase price is entered here on the credit side, which is always the same amount as the debit amount. Finally, we must give a brief description of what this transaction is for. We can write that here in the account/description column at the bottom. That is why this column is named account/description, because we write the name of the accounts here, and also we write a brief description here at the bottom as well. Although this format of general journal is widely known, different companies may use a format a little different than this, especially since nowadays we use accounting software or applications. These applications use different formats with a little variations. For example, you may see the description in its own column at the end, and so on. When recording any transaction in a journal, there are about 4 steps to follow. As you become exposed to more and more transaction types, you don't even think about the steps. It just becomes second nature, and you just start recording transactions without even thinking about the steps. But as a beginner, it is a good idea to pay close attention to these steps. So, the first step is that we need to understand the nature of the transaction to be recorded. For example, is it a purchase or sale of car, or anything else, or a shipment from a supplier, or repair and maintenance of a garage door, and so on. The second step is to identify the accounts affected, the date, and the amount. By amount, I mean the dollar value. Dollar value, of course, for US and other jurisdictions operating in US dollar. When we say the accounts affected, we mean which accounts are increased or decreased because of the transaction. For example, if cash is affected, is it increased or decreased? Or if accounts payable is affected, is it increased or decreased? Thirdly, identify the group or classification of the affected accounts. Is the account affected an asset account? Is it a revenue account? And so on. Finally, follow the rules of debit and credit. We just saw as a table identifying what accounts are debited or credited and when. Let's see one more example of recording a transaction so you get a stronger feel of how we work with debits and credits. Let's say you're an accountant at a large commercial real estate company called ABC PLC. ABC operates by renting residential and commercial buildings. According to all tenancy agreements, ABC collects rental fees every month. Just for simplicity of this example, let's assume that all rental fees are due at the end of each month, and the total rental fee to be collected at the end of a given month, let's say January 31st, is $900,000. How is this transaction recorded in the journal at the end of the month? That is January 31st. Also note that although rents are due at the end of every month, tenants usually don't pay their rental fees until a few days after end of the month. So, we're recording the rental income for ABC Company before receiving any actual rental fees or income. That means we have to remember the accounts receivable account when discussing types of assets. Yes, the rental fee dues are recorded as account receivable on the date they are due, which will later be cleared or settled when actual payments are received. But now, let's see how this transaction of recognizing rent revenue on the due date is recorded in the journal. Now, time to remember the steps of recording transactions. The first step is to understand the nature of the transaction, right? Which is just rent income or revenue due from tenants. That's it. The second step is to identify the accounts affected, the date, and the amount of the rent to be collected. What are the accounts affected in this transaction of rental income earned? One of the accounts affected is obviously account receivable, as we are recording the income before we actually collect it. The other account affected is rent income or rent revenue. Different businesses refer to their income in slightly different ways. Another piece of information we're extracting from the information provided is the date of the transaction, which in this example is the due date of the rental fees, and is provided as January 31st. The other piece of information to identify is the amount or monetary value of the transaction, that is given as $900,000. Great. Okay, what's the next step of recording a transaction in the journal? That is, identify the group or classification of the accounts affected. So, accounts receivable, one of the accounts affected, is an asset account. It was discussed in the financial account section that accounts receivable is an asset because it will soon be converted to cash when collected. The second account affected is rental income, and that is a revenue account. As discussed earlier, revenue is one of the 5 financial accounts, and rental income is just one type of revenue. Great! We collected all the information we need to record this transaction in the journal. Let's see what the last step of recording a transaction is. Okay, that is follow the rules of debit and credit. That is easy. This table is all you need until you start memorizing it. Because of the rental income, our accounts receivable account, which is an asset account, has increased. So, what happens to an asset account that is increased? Looking at the table, we get debit. The other account affected is rental income, and which is a revenue account. Our revenue also increased because of the income earned. So, what happens when a revenue account is increased? Based on this rules of debit and credit table, it is credit. Good. So, accordingly, accounts receivable is debited and rent income is credited. Now, we can go ahead and start recording this revenue earning transaction. Here we have a blank journal. We start with the date, which is January 31st, based on the information we collected. The first account affected in this transaction is account receivable, which is an asset account. And based on the rules of debit and credit, we debit account receivable because it is an asset account and it is increased. That means we enter the amount on the debit side. The other account affected is rent income, which is a revenue account. Based on the rules of debit and credit, we credit revenue accounts when they are increased. That means we enter the amount on the credit side. The last piece of information we enter is a brief description of the transaction, and that is just a couple of words. There's no rule on how to word this. We can say something like rent income for the month of January or something like that. Great! Now, we can easily define double entry. Double entry accounting is the main professional standard of accounting where any transaction of any type has 2 equal but opposite effects: debit and credit. As simple as that. Alright, we've seen a definition of accounting, a relatively longer section on double entry. Now, moving on to the next main topic, accrual. Accrual is an accounting principle where expenses are recognized and recorded when incurred, not necessarily when cash is paid out. And in the same way, revenues are recognized and recorded when earned, not necessarily when cash is received. When discussing debits and credits earlier, we touched a bit about accrual. For example, the rental income recognized and recorded at the due date of the rental fees, even when the actual payments were not received, is an example of a revenue accrual. It works for expense items too. In the utility bill example, we looked at a scenario where a utility expense was incurred but was not paid out. So it's recognized and recorded at the end of a period, like a month. Some companies do regular accruals every quarter and others every month. Let's see one more example on expense accrual. ABC company has an agreement with an IT company so that the IT company provides regular inspection and maintenance services as well as support services on call. Based on the agreement, ABC company agreed to pay $30,000 quarterly, that is every 3 months, to the IT company starting on March 31st. Now, from this information, we know exactly the dates when ABC company pays the quarterly payment to the IT company. So, if we draw a yearly timeline and locate the dates of payments, it looks something like this. The dates of payments when ABC company will pay for IT services are March 31st, and after 3 months, June 30th, and after another 3 months, September 30th, and the next one on December 31st. Let's mark these dates with the letter P on the timeline to just indicate that they are the actual payment dates. Now a question. What do you think happens at the end of the other no payment months if ABC company does accrual every month? Let's take, for example, this date, November 30th. It is not a payment date according to the contract, right? But the IT company continuously provides service throughout the months and quarters, not just on the dates of the payments based on the information provided. So, is there anything ABC company needs to do on November 30th to comply with accrual accounting principle? If so, what? If we look at the timeline again, November 30th is not a payment date, but ABC company has been receiving service continuously starting from the last payment date up to here, November 30th. There are 2 months between the last payment date and November 30th. So, as of this date, that is November 30th, although actual payment for 3 months won't be made until after 1 month, that is on December 31st, we must somehow recognize the expense incurred for the 2 months elapsed as of November 30th. So, the answer to the question, is there anything ABC company should do on November 30th, is yes. ABC company will record an expense for an amount of $20,000 for the 2 months elapsed. $20,000 because it is a simple math that if $30,000 is the expense for 3 months, then a proportional amount for 2 months is $20,000. Wonderful. Moving on, we've so far seen a definition of accounting, basic concepts on double entry, and accrual. Let's now jump to the last topic of this video, the accounting period. What is an accounting period? An accounting period is a period in which all transactions of the period must be recorded and financial statements or reports of the period must be produced. What do we mean by the assertion that all transactions of the period must be recorded? That means transactions that were conducted or occurred during an accounting period must be recorded in that accounting period. They cannot be delayed until the next accounting period. What happens if they are delayed until the next accounting period? In that case, the reports that reflect the accounting period will be misstated because obviously they are missing those transactions. Whenever that happens for any reason, additional notes usually accompany the reports explaining the omission or the misstatement. Good. How long is an accounting period? Well, an accounting period can be a month, a quarter, or 1 year, depending on the preference and capacity of the entity, as well as other factors like regulatory requirements. Nowadays, with the help of efficient accounting applications or software, most business entities have adapted to smaller accounting periods like a month. Some accounting periods like annual or quarterly periods may be mandatory for regulatory purposes. For example, publicly traded companies in US must have a quarterly and annual accounting periods and corresponding reports for those periods. In practice, there are two types of accounting periods based on what needs to be done at the end of the period. Annual accounting period, or fiscal year, and all other accounting periods, such as a month or a quarter. To that effect, we can say that there is only one significant difference between the two accounting period types. Let's see and clarify that. Most business entities, if not all, using professional accounting have an annual accounting period which has a length of 1 year. But the starting and ending dates of the period may not coincide with the starting and ending dates of a calendar year. Some business entities may use calendar year as their annual accounting period, and others use different starting and ending dates. For example, starting on October 1st and ending on September 30th. But the most unique nature of an annual accounting period is that at the end of the period, temporary accounts are closed and reset to zero. Here you have a new concept, temporary account. We will come back to that in a minute. In all other smaller accounting periods like a month, a quarter, no resetting of temporary accounts is done. But all other functions such as making sure that all transactions of the period are recorded and producing the financial statements of the period are the same, regardless of the type of the period. Now, we mentioned these concepts as temporary accounts and resetting temporary accounts in connection with annual accounting periods. Let's see what is meant by temporary accounts. When discussing the 5 classifications of financial accounts, that is asset, liability, equity, revenue, and expense, we did not specify which accounts are temporary accounts and which ones are permanent accounts. So, among these 5 financial accounts, revenue and expense accounts measure activities in terms of earnings and expensed costs for a specified period, such as a year, a quarter, and so on. For example, if you are asked what your income is, that is your revenue, you don't just say a number representing the amount of your income, right? You also attach a time limit with that amount, like monthly, annually, and so on. That concept of time limit to revenue and expense accounts also applies in accounting. Because of that, the balances of revenue and expense accounts accumulated throughout an annual accounting period are reset to zero, making them empty and ready for the next annual accounting period. Now, since the balances on these accounts, that is, revenue and expense accounts, are related to a specified period and so are reset at the end of an annual period, they are temporary accounts. But where do the balances on these temporary accounts go when resetting them to zero? To understand that, let's look at the other groups of accounts, that is, the permanent accounts, which are asset, liability, and equity. Asset, liability, and equity accounts carry balances indefinitely. That means they are not reset to zero like the temporary accounts are. So they are permanent accounts. When resetting the temporary accounts at the end of an annual accounting period, the balances in the temporary accounts are transferred to one of the permanent accounts. This permanent account, where the balances of temporary accounts are transferred to upon resetting is one of the equity accounts, and specifically, that is the retained earnings account. So, retained earnings is one of the equity accounts where the balances of revenue and expense accounts are transferred to at the end of each annual accounting period. One last thing about accounting periods: the purpose. What is the purpose of accounting periods? Why don't we just continue recording transactions indefinitely without having specified periods to reset accounts or reset temporary accounts? Well, the primary purpose of accounting periods is to slice or divide accounting information into measurable time units so that reports are prepared at the end of each period. The report or financial statement where the temporary accounts, that is, revenue and expense accounts, are reported on is known as the income statement, or sometimes called profit and loss statement. On the other hand, the report where the permanent accounts, such as asset, liability, and equity accounts, are reported on is called the balance sheet, also known as statement of positions. Alright, that was it for now. What you saw in this video is the core accounting concepts, principles, along with how they are practically applied in accounting. That is, specifically, we looked at what accounting is, had a close insight into these building blocks of accounting, such as double entry, accrual, and the accounting period, as well as other related principles and how they are practiced. Like I said, if you encounter any topic or a piece of idea that you're not sure you understand or need more clarification on, just drop it in the comment box below and I will get to it as soon as possible. Also, if you don't mind, like this video and subscribe to this channel. That will help to have notifications sent out to you when I publish new ones. Also, if you know someone like an accounting student or anyone who likes to base their accounting knowledge on a strong foundation, share this video with them. My next accounting video will be built upon this video and provide you with all major tools and knowledge that any professional accountant must know. Alright, until next time, take care.